Hey, Flynn, Phoebe, Jordan here from Mountway Finance. Here's a bit of advice about this business purchase that you're looking to make. Firstly, we started with your debt capacity. So my understanding, obviously, from our discussion is that you're going to buy this business. It's a yoga studio. You're going to put a manager in, effectively a manager head coach, and more or less it'll be run as a side gig whilst you keep your current employment. So if we look at how your current debt capacity sits, just relying on your existing PAYE incomes alone, we have here a bunch of great results. Effectively, with all of your details into this calculator, we have debt capacity down this column here, well into the millions across most banks, including non-banks and major banks. So that provides lots of options for financing this loan. But the big question then comes down to how much equity do you have in your home that can reasonably be borrowed against? If we look here at the funding table, we have a purchase price of around $450, and we'll get to why that might be around about the right value. We have two modes of purchase: asset sale, share sale. And as you've described to me, you're friendly with the seller, and therefore, you can openly discuss which one's the better. There's obviously stamp duty with the asset sale, so they're a little bit higher in the total outlay. With a house value of $850, generally as a home loan, as a cash out against a home loan, you can pull up to 80%. There are some options to go to 90%, but either way, it doesn't quite get you there. With existing debt on your property at $496, effectively you can take out $184,000 additionally until you get to 80%. Now, the situation changes with a business loan because you are actually able to extend beyond the 80% number up to a certain point in a realm we call unsecured lending. And this is bank lending. You're able to do this with one of the major banks, and obviously there's much more available when you start to use equity in the house beyond 80%. Nonetheless, in both of these scenarios, there is still a component of cash that would need to come from you to complete that purchase price. So the funding position is a bit more challenging, but the servicing position is very strong. So it looks like a loan you can do, presuming you can come up with the additional cash. Now, in terms of the business itself, here's a summary of the financial statements. What I've done is I've tried to be as generous as possible. You mentioned that you know the owners, and then you want us to be fairly open book. So we've outlaid the last 3 years here. There's a little bit of information about the trends. This year has seen a bit of a dip in income. That's to be sort of understood before you go making offers. But in the spirit of keeping this as friendly as possible for the seller, I've identified a bunch of add-backs here. These are add-backs that are probably unique to their ownership and their structure and decisions that they make. For example, often people use their mode of transport within the business as a tax deduction. That's perfectly fine. You may not decide to do that. So the idea is that you clean up the profit and loss statement by taking these add-backs out. You get to an adjusted level of profit here, but then you want to put back in what you plan in order to run the business. And you've mentioned putting in a manager / head coach who would be full-time and effectively continue to run their studio. So with that back in, around about $100,000, this is a profit. Now, I've taken a last 2 years average, just for the sake of fairness. There is a number of ways you can cut this, but the numbers are sort of all coming in 90 to 100,000, except for this one, which is an outlier, and it's 3 years ago anyway. Now, that's very important because when we talk about yoga studios, gyms, things like that, there is a standard set of valuation metrics. This is generally where the market lands when buying and selling gyms. And it comes down to either a revenue multiple of 0.8 or an EBITDA, which is another word for profit, of 2.75 multiple. Now, there's obviously variation. Sometimes people are a bit higher, sometimes people are a bit lower, but that's generally where the market seems to settle in. And so you get these purchase prices here that are driven by those multiples of something a lot lower than what the seller is asking, of around $450,000. So that's for you to think about with regards to whether or not, even if you can borrow the money, you would actually want to lay out this money. Now, how this sort of looks in terms of negotiating about that, take a return point of view. Now, this is a more or less retail business, but it does have a membership. So retail is all about people are walking through the door, and you don't actually know when and where they're going to come from necessarily, and whether they're going to stick around. So each is a new day, and it's hard to put money down expecting years of return if you don't exactly know what's out there in terms of ongoing revenue source. That's a little bit better with a membership-based business, because effectively you have these recurring memberships and it's up to people to cancel them, right? And you might have sort of a month to 3 month notice of that, and you can fill your books with membership. So you've got a bit more reliability in your forward look on revenue. Now, the return calculations, these multiples, for example, is about the bet you have, right? So if you buy something on 2.75 multiple, it's essentially saying that you're going to rely on that level of profit at least for 2.75 years. And that should roughly define its payback period. If we sort of put in here the 250,000 period, we get a payback of 2.7, and that's obviously driven by this multiple. That's the way to think of multiple, and that's the way to think of returns. It's reliability of that profit over that period of time. And by flipping this, so we have sort of the inverse of the multiple, that gives you the return. And the return is important because you put it into perspective with things like real estate, things like share market. And I have done that down here. Being from Karratha, I've used an example of a property in Karratha, which is yielding 9.5%, and there's ownership expenses of around 12% per annum. So its yield is 8.36, or a 12-year payback period. Now that's property. You know, I mean, granted, it's in Karratha, it's a bit more of a riskier place, but that's property. If we do the same thing in Perth, we sort of get out to something that looks like a 30-year term, but very, very safe, which is why your yield is generally lower when it comes to property. I've got some commercial property things here. If you wanted to see what it looked like for the share market, on average, it sits in the 12 to 15% range. And if you're lower in that category, you're obviously dealing with blue chips. So that is listed companies on the share market. So we've got a high degree of rigor if you're going to get to the share market, and you generally got bigger companies. So 15%, which is why when you buy a small business in a remote location, you are generally looking at bigger returns in order to compensate for that risk. As you go up the price scales here to something like what you're thinking of offering, you can see the return comes down to 21%. And the question you need to get comfortable with is that a good enough return for this studio that you're about to purchase? Okay, now we have some advice here from the accountant. I'm purely passing this on because this is about whether or not the share sale or the other sale is a good model. It's not my area, it's tax planning. I'd highly encourage you to get in touch with this guy I'm recommending and talk further about this. So in short, yes, I think you can buy this, and I think you can buy it for up to 450 and also purchase and borrow the money to do so. However, I would suggest to have a serious think about whether or not 450 is good value and whether or not you can discuss a lower purchase price. Thank you very much, guys.